All right. So I think we want to talk about a recent update that Vanguard did to their capital markets outlook, and it got a fair bit of attention, maybe more so than obscure financial data like this normally would, because their prediction over the next 10 years is quite low for the anticipated returns on things like US large cap growth stocks, which are the most popular investment of the last few years and a big piece of everybody's portfolios. Rather than nitpick their methodology or say whether we agree or disagree, I thought it might be a good opportunity to talk about the differences between how we view capital market outlooks from shops like Vanguard. JP Morgan puts out one. Pretty much every big investment bank, kind of has their own take on this. So talk about how they're often portrayed versus like how a financial planner might actually use them in practice. So perhaps I'll begin by saying explicitly like what capital market outlooks are not. They're not a market timing tool, even though the way that you'll have them reported from place to place is like this one, for instance. Vanguard says US large cap growth stocks are going to return 4% over the next 10 years. Like, should you be selling that? It's like, should you reallocate your portfolio as a result of it? It's not that.
Yeah.
So
Goldman did one too that was like 3.5%, like at
Right.
the end of 24 or something like that.
They explicitly said that in the Vanguard piece. They're like, this is not like, we asked people about that and they said this is not meant to be like a decision making tool for you to automatically go and change your portfolio tomorrow about this.
Yeah, but for whatever reason, we like to get this information and then turn it into like a market timing tool. So it isn't that. I think maybe I'll kick us off. Like what it can be is, if you look at what Vanguard put out, and everybody reports in a similar format, it can be like a probabilistic guide to how I would say, intermediate term future might look based on valuations in the market. So like, while you're not timing the market, I think valuation based work like this can guide you over the intermediate term. And that in a planning horizon can mean like 10 to 15 years, as opposed to the long term, which is like 20 to 30, because 20, 30 year returns tend to just converge on the historical averages. But we might look at something like this to guide something shorter term about the portfolio. I don't know. What do you guys think about this, and how does it factor into planning work that we do for clients at least?
First thing I'll say is these kind of reports almost become self-fulfilling prophecies, in the sense that it's like, well, especially after what we saw the last few months in the market, where, as Brendan likes to say, number go up, things really did well, markets did well. People sometimes are just looking for an excuse to sell, or an excuse to rebalance, or an excuse to just take some money off the table. And so in the short run, these things almost become self-fulfilling prophecies, in the sense that people will use them as their stick.
Yeah, I think for us, it especially when talking about things like US large cap growth and things that have worked recently, I think it's easy to just assume that it can continue on forever, but we could kind of use this as a way to realize that that's not going to be the case, and kind of point towards owning a little bit of everything. There's going to be times where US large cap growth rocks for a handful of years like it has, and then value could take over international stocks, small cap, mid cap. So for us, I think when building a balanced portfolio, it's important to remember that, there could be, over the intermediate term, periods where, the things that have worked recently might not continue to be strength there, and that we could see some transition. And it's important.
It's kind of
the diversifying.
Yeah.
The inverse of what Vanguard suggested in this is, if you look at the data for their expected returns going forward, you can pretty much take the reciprocal of that information and say what's done best most recently.
Right.
Yeah. And if you have a diversified portfolio, the silver lining of their prediction, whether it comes true or not, about US large cap growth stocks, is that if you have other pieces of your portfolio, those are some of the areas that have higher anticipated returns because they haven't done as well in the last few years.
Right,
So
sure.
yeah, I mean, like, diversify, don't just hop from one to the other. That's not what this is trying to tell you.
Yeah.
I think that
absolutely
as
not. Right.
as planners, when we're building, plans and retirement projections for people too, we try really hard not to fall into the trap of what's done well for us lately. We want to avoid recency bias. I think one of the ways that we do this, these capital market assumptions are looking to the future and making educated guesses about what future returns are going to be. But another thing that we can look at is historical returns and look at what the market has done over, basically we have about 80 years, 70, 80 years worth of solid market data. And we can look back and say, if your plan works using, lower investment returns than, and historical averages say that we can expect to earn a couple percentage points more than that, then, your plan looks like it's in good shape. But what we don't want to do is assume high investment returns or higher than historical averages and say, okay, your plan looks good because, we're going to earn 12% per year or whatever. It also, we also have to account for surviving the short term in order to get those long-term historical averages. And if you think about it in terms of, standard deviations, it's basically, not to get too statsy, but 2 standard deviations outside of an average return means that we can expect returns to fall in that window 95% of the time. It depends on how you're invested. If you're all, U.S. large cap growth, you're 100% invested, the standard deviation is going to be something close to 20%. Your average return is going to be higher, but the volatility that you have to endure is going to be extremely wide. If you get to something like a 50-50, the average return is going to be less, but the standard deviation is going to be less. So the variability in returns is going to be less. And it all depends on where you're at and what you need from the plan, how much risk you need to take, how much risk you don't need to take. These are all things that we're taking into account and when we're thinking through retirement plans.
I think there's a trap in there in the sense that when we talk about, or when anybody in the business talks about average returns, they say over the next 10 years, the average return we expect is going to be this. It doesn't mean that you're going to live in that -3% to +3%. You can still have +20% and -20% years. Over 10 years, though, the number may work out to fall in their range. And if you ask people what they expected in the, that period of 2000 to 2009, where the S&P returned, the narrative is the S&P returned nothing.
Lost year.
A lost decade. There were plenty of opportunities to see +20 and, -40 in that. So, yeah, averages can sometimes be a little misleading.
I think the other thing about that time period is the other areas of the market that did well.
Yeah.
I think, like emerging markets were hot during then. Small caps tended to do well. So again, I think that just speaks to diversifying and different things, taking the baton at different times.
We have to we have to put up one of the investment return quilts here so folks can just see a sample of what we're talking about.
Yeah.
Well, if we're talking about diversifying and planning in a portfolio construction line of view here, like we have to make some assumptions about the future. So we've talked about historical returns. We've talked about things like Vanguard or JP Morgan or Goldman Sachs and their capital market assumptions. There's often a lot of discourse in the planning community in terms of how financial planning tools will give you the ability to use both in a planned setting. So you can use the historical returns, you can use capital market assumptions from whatever shop gets their stuff onto the planning platform you're using. And then there's oftentimes a third option where like the advisor can go in and just like fill in whatever the heck they want, which I think is the worst of the three. It's like, I think the amount of hubris needed to think that you know better than the historical returns or the capital market teams at a shop like Vanguard or JP Morgan is just unbelievable. But so setting that one aside, because I think it's junk, it's like, so which one is better? And unfortunately, I don't like, it's not to be wishy-washy, but I think you can use both to provide context to a plan, because as Casey was describing before, I think you can use conservative assumptions based on history. So like you could reach the same set of assumptions by using low end historical outcomes, like stuff that instead of using the average historical return, you could use like the 25th percentile historical return to say, like, if returns are just bad, this is what they might look like, and use that average return in the plan for all the asset classes you're allocating to. Or you could use a capital market assumption like this Vanguard one that kind of, is negative on some pieces of a diversified portfolio to see like, all right, well, what if they're right? Like how do the returns project to look on our mix over, whatever planning horizon you're using, to kind of stress test the plan. And I think both can be valuable. And it seems like a lot of people, a lot of advisors will fall to like one camp or the other, or like to just input their own predictions kind of thing. I mean, any thoughts on that from our perspective?
Yeah, I think in terms of just, pinpointing one set of numbers and taking that as gospel, I think it's just setting yourself up for failure, so to speak, just because if there was one set of numbers that told the tale and worked every single time, everybody would use that and no one would even bother putting out their own information. So I think taking multiple sources of information and kind of coming to your own conclusions and using a blend of everything is probably the safest bet to not overweight or underweight the importance one or the other. Because like I said, if there was one end all be all answer, then everybody would use it all the time, and it would be easy.
Yeah, we're guessing, I guess, is
much, yeah.
Whether it's us or the capital markets team. I mean, there's work that goes into it. It's not literally just chucking darts, but like we're making educated guesses about the future, no matter who's doing it.
Yeah, and I think they're more educated guesses when you have more sources of information to kind of use as your backdrop.
I think the important thing is, we all want certainty, especially, folks who are looking to retire or, invest their money for whatever purpose. They all want certainty. Everyone wants to know what's going to happen in the future. Unfortunately, there's no way for us to be able to know that. So I think just both of whether we use capital markets or historical returns, I think they both tend to get us pointed in the right direction. So we're directionally headed in where we want to go. And I think that's really, the whole point of financial planning and retirement planning is not necessarily being exact. Some things we want to get exact, but the big picture is we just want to know that we're headed in the right direction and that we're going to be okay on that path, or if we need to make changes, what changes do we have to make? So, yeah.
Without hijacking the conversation, I'm hopeful that we can go back to something that Brendan said right at the outset about the intermediate term being something like 10 to 15 years. We could have stopped the video right there, in my opinion, because I think for so many people, intermediate term is
like Christmas,
May or June.
Yeah. Right.
Do you want to just talk about that from a planning perspective? What we see as long term and intermediate term?
Well, yeah, and I totally get that people live their lives, and a year seems excruciating when we're talking about like a market downturn or anything like that. So I'm not suggesting that like we all have these 100-year time horizons. I get that we don't, but when you look at historical data for stock market returns in particular, I think that the longer the time horizon, like when we get out to 20 or 30 years, no matter what your starting point was, the returns all converge on the historical averages. However, if you're investing for a shorter period of time than that, which everybody is to some degree, depending on what their goals are within the portfolio, the returns, the range of them gets wider. And so, like, depending on your starting point, if you had a good one or a bad one, you could have had a high end outcome versus a low end outcome. And so that variability is, I think, when people do capital market assumptions, they're trying to talk more about like right now as a starting point and looking over the 10 to 15 year window after that. If you're going to invest for 30 years, you can chuck it out because it's probably just going to look like the historical returns. But if you're concerned about that more intermediate term, you can maybe use this capital market assumption as guidance on that. And if the returns on that sort of a time horizon aren't where you want them to be, then like the way you get more certainty or hedge that risk is probably like seeing if your plan works, having more money in safer, shorter term assets versus the long-term ones that are not giving you the sort of returns that your plan requires. Like if you're going to use the information, I think that's how you use a capital market assumption, as opposed to Vanguard said U.S. large cap growth to sell, get out.
Sell.
That's not it. That isn't it.
Yeah. Usually how it's portrayed, but not important to separate the two.
I think you can also use the two different kinds of returns contextually within a plan, because if you've got capital market assumptions that are giving you a slightly negative view on a large piece of the market, like you can use that in terms of the lower returns it probably creates for a financial plan to stress test. And then you could compare that to the historical returns to say, all right, well, even if the lower returns are probable, what if we get a low probability outcome to the upside and things are good and they just look like history, to then just look at like how much room to the upside could there be? Because the balance we're always trying to find in retirement plans is obviously you want to be safe, but once safety feels like it's feasible based on the inputs, then like how much higher can you go in terms of like spending and lifestyle? Like people aren't looking to, die with millions of dollars in many cases, unless that's their specific goal. So it's like, yeah, we want to coach people to safety to make sure that they don't run out, but also we want to coach them to not leaving opportunities behind when they're no longer here. And I think you can use different sets of return assumptions to kind of highlight that in a plan. And that sort of context is the good part of return assumptions, as opposed to the bad part in terms of how they're often, I think, misportrayed by individuals or misused as a market timing tool or anything along those lines.
Well said.
I think that also speaks to the beauty of an ongoing nature of working with a financial planner and doing ongoing check-ins and stuff like that, is you can assess in pretty much real time how the plan's going versus the latest set of projections that we did, and what does that mean in terms of the spending that you're doing from the portfolio, or it just highlights tweaks that can be made along the way to either protect the safety or maximize your plan to the fullest.